Hello once again. In this chapter, we are going to discuss and explain the depreciation accounting. So, what does mean the depreciation accounting? And the depreciation is defined as the systematic allocation of the depreciable amount of an asset over its useful life. So the items of property, plant, equipment are usually depreciated in order to maintain matching principles as they are in operation for more than 1 year. They assist in production, the revenue in more than 1 year, and therefore this cost shall be split among those years in order to match the revenue they helped to produce. So when dealing with the depreciation, please consider these 3 basic things. First things is depreciable amounts. It simply means how much you are going to depreciate. It is the cost of an asset or other amounts substituted for cost less its residual value. The second point is depreciation period. Is simply how long you are going to depreciate. It is basically asset useful life. And useful life is the period over which an asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by the entity. So IAS 16 highlights several factors or the points that shall be considered when establishing the useful life of items, the expected usage of the item, technical and commercial obsolescence of the items, and legal and other limits on the use of the asset. So when we are going to set a useful life, we need to consider some the external reasons, such as technical and legal and other reasons. For example, in some countries there is a limit on rules or regulations. Let's say in such a country they do not allow the useful life of building, the accommodation building, to be last more than 30 years. But practically or logically, this building could be more than 50 years. But you could not avoid these legal limits because it's based according to the country or the law regulation. So we need to consider these things when we are going to set our assets useful life. Useful life and assets residual value input or to depreciable amounts shall review it at least. So the useful life of the asset should be reviewed at least at each financial year end to avoid fully depreciated but still in use. Because I heard many questions from the accountants saying, "Hey Tom, our machine is fully depreciated and the carrying amount is 0, but we still use this machine. What we gonna do?" From the beginning, there is something wrong. That the useful life of the estimate of useful life, whether it's wrong or they forget totally to review useful life at each financial year end, and that's why it's as per IAS 16, it is obligation to review the useful life of items yearly at least. Depreciation methods. An entity may select from the variety of depreciation methods such as the straight line method, the reducing balance method, the machine hours method, and the sum of the decades method. The selected method should be applied consistently from period to period unless the change is required by IFRS or reasonable circumstance appear. In this case, the change of the method must be disclosed and stated. So if you choose one of these options, you need to stick on that options. You cannot shift or change to the other methods because based of your needs. There is two options: either by the change is required by the IFRS or the change is needed by your company because it will help for the fair report in financial reporting. But at all cases, you need to have reasonable reasons in order to change or shift from method to method. Examples, we're gonna have the examples on these methods for each method on depreciation method. So let's imagine this example: a vehicle bought for a business. A vehicle bought for the business costs $24,000. Is expected to be last for 5 years, and then be sold for scrap for the 4 years, 4,000. Usage over the 5 years expected to be like the first year 240 days, the second year 130 days, third year 80 days, fourth year 160 days, and the last year 50 days. The question: work out the depreciation to be charged each year and under the straight line and reducing balance method using the rate of 35%. This is given us, and the machine hour method, and the sum of the decades method. So the answer under the straight line method, depreciation for each of the 5 years could be as following. Annual depreciation is the cost minus residual value divided by useful life. It means the total cost is 24,000 minus 4,000 divided by 5 years, which gives us $4,000 per year. Under the reducing balance method, depreciation, the depreciation for each the 5 years is we have years up to 5 years, and the rate is already given So here the first year is going to be 35 years in times 24,000 gives us 8,400. In the second year, we're gonna reduce the 24,000 minus previous depreciation, which is already charged in profit or loss, and it gives us 15,600. This into the rate which is given gives us the depreciation for this year. For the second year, going to be 5,460. The third year, the 15,600 minus the previous year depreciation, the amount gives us 10,140 into the rate gives us 3,549, so and so on. In the last year, the balance of bringing books value down to 4,000, the residual value, is equal this one. These amounts, the carrying amounts, 650,591 minus the previous year depreciation gives us minus previous year depreciation minus residual value. The remaining balance in the last year is it is 284. Under the machine hours method, depreciation for each of the 5 years is calculated as following. Total usage days. Total usage days is the total of these usage days. The total of these days which are given. 650 days depreciation per day. 24,000 minus 4,000 as residual value divided by 650 gives us 30.77 per day. So we need to allocate this per day into the usage days over the depreciation period. So the first year, 240 into 30, the depreciation per day, 30.75 gives us 7,384.8, and so on. In the last year, we will have 20,000. The total of this is going to be 25,000. The note, the answer does not come exactly 20,000 because of the rounding out of the depreciation per day usage. So because of rounding, the answer is not exactly equals 20,000. The sum of the decades methods beings by adding by the years of expected life in this cost. So in this method, we can add up the years of depreciation over its useful life. We have 5 years. So 5 years means a total of years. 5 plus 4 plus 3 plus 2 plus 1. It's the total give us 15s. And then we will allocate these 15s spread over each year. The depreciation amounts of 20,000 will be allocated as following. The first year 20,000 into times 5 divided by 15, the total years gives us this amount. And the second year 20,000 into 4, and then up to the end of the last year is the total will give us the total of this amount gives us $20,000. And this is the end of the depreciation accounting, and see you in the next chapter, review of useful life.